think a struggle I'm seeing is really like the middle stage startups, right? Those that raise several rounds of capital, say over the past 5 years, right? I think what I've realized is that I've had to be very thoughtful in understanding where the current business is and helping them discuss what their challenges are, and more importantly, like talking about how high the next bar is, right? Because I think the previous rounds the bar wasn't that high, and so I think as long as we make some amount of progress, the next round will come, right? Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 20,000 members and get transcripts, resources, and community at www.bravesea.com. Do you manage your own IT for distributed teams in Asia? You know how painful it is. Essevel helps your in-house team by taking tough tasks off their hands and giving them the tools to manage IT effectively. Get help across 8 countries in Asia Pacific, which includes onboarding, procurement, device management, real-time IT support, offboarding, and more. Gain full control of all your IT infrastructure in one place with our state-of-the-art platform. Check out Essevel, ESEVEL.com, and get a demo today. Use our referral code BRAVE for 3 months free. Terms and conditions apply. Hey, morning, Shiyan. You flew in at what, 5:30 a.m. this morning? So
that's right.
Crazy. And what your strategy is for the morning is what? Like
stay awake. My strategy is keep going.
Keep going? That's a bonkers strategy. I'm the kind of person like go home, I just take a nap.
No. The actual key is on the flight, I don't eat. That's my strategy.
This is a weird life hack. Okay, hit me. Why does it work?
Because you're trying to like convince your body that you're in the destination time zone, right? And so your body gets a lot of cues based on like your blood sugar levels, like when you eat.
Yeah.
And so if you don't eat for the whole time, and then you land and you eat according to your destination schedule, it's easier to reset. So like I landed, I took a shower, and I went to Gimmo.
Wow.
And I ate some Thai Hokgui.
Oh, very
incredibly
nice.
Unhealthy, and I have my taping.
Oh, wow. Yeah, you're a stronger person than I am. I'll be happy to sleep right now. But let's power through.
Yeah, let's do it.
And I think what we were discussing was, hey, right now, a lot of folks are asking, what is going on in venture capital, right? I mean, obviously, everyone was very bearish. And then after that, things started exploding and imploding. And then people are just saying, like, it's a tough market. But I think a lot of founders are like, are we getting better? Have we hit the bottom yet? When does it get better? And I think you and I have some thoughts. You've obviously done some travel, talking to capital allocators and other VCs in Silicon Valley. I also have my own point of view. So I'd love to kind of like discuss and just say, where do you think the venture capital and startup market is today?
Yeah. The VCs are almost like congenitally optimistic, right? Otherwise they wouldn't get into the business. And so I think when you talk to VCs, myself included, generally you're a pretty positive person. But I think, I just got back, as Jeremy mentioned, from 2 weeks in the US, talking to a range of both fund managers and allocators. And I would say the mood is pretty tempered. So there's sort of like high level, like, yes, we believe in innovation, we believe in this asset class, but also recognition that, hey, the market was insane over the last 2 years. And people got a little bit out over their skis, paid too much, and that's all kind of coming to a head. And so while there continues to be a lot of excitement around AI and those use cases, people are also busy dealing with what's going on in their portfolios. And that's like helping people shut down gracefully. We talked about acqui-hires. And I was talking with another manager, and he was like, yeah, we helped a couple of people get acqui-hired. I was like, what is the market for acqui-hires right now? It doesn't seem like there is one. He's like, yeah, it's more of a face-saving move. they get slightly better packages than if they had just applied for jobs. No one made money on that, right? And I think if you think VCs are optimists, right, founders even more have to be optimists, right? Like, it's sort of,
Yeah.
I always kind of say that entrepreneurship by definition is like a little bit insane,
Right.
because the expected value outcome of entrepreneurship is probably not higher than some cushy
Yeah.
job somewhere,
Yeah.
but people do it anyway. And so I think maybe coming into the year, there were a lot of people who are like, I think I can raise. And they're running into a few things: is their own existing investors don't necessarily want to bridge them or don't have the appetite to bridge them, or their own and they're not sort of reading that signal, right, as like, hey, I either need to like revise my expectations or change course. And so they kind of continue to go out into market and get sort of lukewarm responses and get very long drawn out processes. And so I think that's still taking a bit of time to funnel through. And so yeah, I think like people are still, I think, working through that.
Yeah.
I don't think we've seen the full impact of that yet, right? We've started to see the recaps. We've started to see people like have sort of reality realization moments, but I don't really think it's gone all the way through yet.
Yeah.
And so I think that's kind of the mood, right? On the one hand, I think investors are like, this should be a great vintage to invest because valuations are all down. But on the other hand, you have stuff from your prior funds that you are managing, and you still need to help all those guys. And there's sort of, I think, a bifurcation between people who sort of either they were always pretty frugal, and so they have planned ahead accordingly, or they got the memo early and they cut and adjusted fast. But those who didn't, I think they're facing a much worse fundraising environment, and that's just reality.
Right. Yeah, I think there's two parts, right? Which is what's the market, and then obviously what founders should do. And let's put the second part a little bit down the road, and let's kind of sit with this feeling about what the market is today. I agree with you that the market is tough. And I think one way that I see it is that a lot of funds, and I hear this through the grapevine, I talk to other folks, is that what is the majority of their time, the partner's time doing, right? Are they talking to new companies, or are they working with their current portfolio companies, right? And I think there are many funds in Southeast Asia that are very, very focused on their current portfolio, right? Kind of helping them, the operations, layoffs, the next round, etc. And so I think it's not what you say that you do, right? It's about what your time and allocation is, right? And I think I agree with you. I think there's a lot of VCs who are very busy working with their portfolio companies. And I think they have also their associates and portfolio support folks also working very deeply with their portfolio as well. And so I think that contributes, I think, to a lot of, like you said, mind share, which is that, right? And so how much mind share is there left to look at new companies and new deals? I think that's also driving some of the folks who are leaving venture capital in terms of teammates, etc., because they want to do deals, right? But they're focused on their portfolio and management. So I think it's been interesting to see that play out, actually.
Although, like, it's all part of the job, right? Like, writing checks isn't the whole job. Like, writing checks is like step 0.
Hello? The past 2 years was just, remember all the strategies was just write checks, let your winners ride, do no work, and keep finding new deals, right? I think that was like you said, the MO, right, for the past 2 years was that the best founders don't. I don't know. It's consistently up. There's no down. There's no sideways.
I don't know. I mean, as business is never consistently up, right? The whole thing is a roller coaster. And like, I feel like most of the time something is like deeply wrong. You're just trying to stay afloat. So yeah, I mean, I think the mood is measured, and I think alongside the sort of startup funding cycle, there's also the fund funding cycle.
Right.
So I think there's also the feeling that like a lot of funds got started kind of the last 3 years.
Right.
And it's really unclear for those funds, what their trajectory and prognosis is going to be, and whether they're going to be able to raise second funds.
Yeah.
Just given kind of what that environment was at that time.
Yeah.
And so, I mean, there's this crazy stat, right? Which is if you take the top, I think 10 or 15 large cap technology stocks in the US,
right,
and That is like more than the combined capitalization of the London Stock Exchange and the Tokyo Exchange.
Wow. It's crazy.
Yeah. And so basically people pay more if you're listed in the US, but also that you could actually get a lot of the returns you wanted in technology just by holding the top 15
Right.
publicly traded tech stocks, right? Which
Yeah.
then you're like, okay, like what does that mean for the private markets?
Yeah.
And then the other thing is that like, if you look at publicly traded companies with market caps of over 10 billion,
Right.
that's only 10% of the total capitalization of the market.
Right.
So there's like, that's 90% that's under 10 billion. And so like, which is most of private markets, right?
Yeah.
So do you believe that that long tail outperforms on a multi-year horizon relative to the risk reward ratio of holding sort of the top 15 publics?
Right.
So anyway, that's like the bear case, I guess.
Yeah.
But having said that, I think most people's allocation to privates is still very, very low.
Right.
Right. And so they do all have room to like increase on the private side.
Right.
But it's just when are they going to do that? Did they already get burned? And have they soured on the asset class altogether?
Yeah. Yeah. And, obviously, the VCs are writing the decks, right? It's like, hey, valuations have returned back to normal. Great companies are founded in good times and bad. We have a proprietary access, deal flow, and approach that lets us pick the winners. And we're super confident our fund one, returns are going to crush it. Just look at the paper valuations today. Can you please let us raise fund two? No,
Yeah.
not good. Not a good enough deck these days.
TVPI and DPI, very different things.
I know, right? I mean,
do you know how many venture funds there are?
No, don't hit me here.
Like 4,000.
4,000?
Yeah.
Really?
It's a lot.
Oh, I was going to say that's very small, like 4,000.
But for a very niche asset class, that's like a crazy number. I think when I was working on Sand Hill like 15 years ago, I think there were probably like 1,000 plus in the NVCA directory.
Yeah.
So there has been like a huge explosion. I was at another event last week called Capital Camp, and it was a much broader sort of investment management type of conference. And like VCs just put one segment of that, right? There's a lot of people like small middle market private equity, real estate, all this sort of stuff that are much more established, much larger asset classes.
Yeah. I think 4,000 is, okay, now I have to sit with it. Yeah, I think there's also a bit of a power law, right? In the sense that there is a lot of small, medium, and then the large ones obviously have very large fund sizes. So I think there's a dynamic where it's not just the number, right? But also I think, I haven't seen the numbers for myself, right? But what the top 10%, what the number of employees or AUM, or could be a very disproportionate size as well. Interesting times.
Yeah.
So does that mean we're at the bottom? Yeah. Is the worst already over? Will things get better? That's what people want to know.
I don't know, though. Right? I mean, I'm kind of worried about this debt ceiling thing.
Yeah, it's like,
the headline was like, they've extended from June 1st to June 5th. And you're like, okay, it's not much better. It's already May 27th.
Yeah. Yeah, like you go to record, you're like, we're totally fine. We call the bottom. And then the US is defaults on the debt. The entire global financial system implodes.
Although the market is up. Did you see? The market is up because they think they're going to have to do something. But like, I don't know.
It's like when people shit on Jim Cramer, right? And then Jim Cramer says like, I don't expect America to default. And everyone's like, oh, we got a better other side of this.
Yeah, it's the opposite. The inverse Cramer index or whatever
exactly,
it is, right?
Exactly, right.
Yeah, so I don't know. I mean, I think like there's two countervailing forces, right? I think there's like the excesses of the last 2 years need to like work themselves out of the system.
Right.
As you said, a lot of VCs are occupied with their current portfolio and like trying to fix and save stuff. And then on the other hand, you've got this amazing AI wave and excitement and new applications and people jumping in. So that's kind of like something to get excited about.
Yeah.
The macro stuff. Inflation was accelerating in April, which then makes me worried about the June rate meeting.
Yeah. So let's talk about the macros, right? So at least because obviously we're not going to predict, we're not macroeconomists in that sense, but what are the key things or factors that that would help the situation, right? So one is obviously inflation dropping, which to some extent is linked to perception that this will lower interest rates. And
Yep.
when you lower interest rates, it increases the future time value of money versus, well, not increases values. It doesn't drop as much, right? And so
It
we can
improves the
afford,
DCF calculations.
exactly, improves our vision
No,
of
but also
future.
credit, right?
Yeah,
It just
exactly.
makes credit cheaper, which allows people to invest more, right?
Yeah, like debt and capital expenditures.
Yeah.
That's a big piece. I'm going to say US elections, I would say, is a big one as well to some extent, because I think there are different visions for the economic future, right? Between the three of them. And I think they obviously impact different categories, different verticals, different regulation targets, right? For example. So, for example, the FTC right now is doing a lot of work to stop acquisitions, right, of many companies. And that lowers the exit potential, right, for so many companies that were going for a trade sale, $100 million sale, even $1 billion sale.
Yeah, but I don't think FTC is going to stop the $100 million sale, right?
Yeah,
like, those are like much harder to make the sort of monopoly arguments.
Yeah. Well, I think the tricky part is that there were certain buyers that are very cash rich, right? So you obviously your FANG, so on and so forth, right? Your Google, your Alphabet, who historically just did a lot of those acquisitions, right? And were happy to pay for the talent and the know-how and approach, right? And now because of the regulatory side, I think they slowed down their thing because they don't want to trigger more of that, right? So I think you're right to say it's not as if they're blocking, but I think there's also a self deceleration, right, of those deal flows as well.
It's an interesting question. I would have to ask. I don't know.
Yeah. Caterpillar is doing very, very happy right now because they never could get technology talent for their tractors and farm equipment because it wasn't hot. But it turns out with the current like layoffs and everything, they're kind of like moving towards there. But yeah, so what are other macro stuff? We don't go to war globally. That'd be nice.
Yeah, there's the China-US conflict and whether we can like reduce the temperature there.
Yeah, so that's a big one sentiment-wise because it's not even a black swan event, right? It's this unknown scenario that people are planning for / planning around. What else is there? Anything else? I think those are major ones, right? I think those are major thresholds. Like in a world where interest rates are dropping, inflation is dropping, US-China relations improve, right?
Yeah.
Then I think that would be the macro bottom. Yeah.
So things can swing back up.
Yeah, things can swing back up.
But I think now I think it's just all predicting that things will get a little bit worse.
Yeah, so we're not at the bottom yet, but you're like nearing the bottom. Like it can't get much worse.
I mean, it doesn't change what people need to do, right?
Yeah. Ooh,
which is
what do people need to do?
Find customers, make money.
I thought it was fundraise and make a deck. Anyway.
I mean, I think we talked a little about this before, right? Yeah. Which is like, if you want a venture scale return, can you imagine this thing being at 100 million of revenue?
Yeah.
Within kind of like 5 years.
Right.
And what do you have to believe for that to be true?
Yeah.
And so, like, for founders, I don't think it really changes the equation much, right? Yes. Well, it changes the equation in terms of like how easy you think it is to fundraise, but in terms of what you need to validate in your business, the changes you have to validate faster than you thought, probably. But I assume that you'd want to validate those things anyway, right? Because you're spending your time on it. But I made a joke to one of my friends when I was in town. And I said, if I ever own a horse or a boat, I'm going to name it Operating Leverage. Because I really think this is a very important idea.
I mean, I got to hear this.
Like,
a horse or boat. Keep going.
I mean, it's also a bit ridiculous, right? Because a horse or a boat is like the opposite of operating leverage, right? But because you would just spend money maintaining it.
Okay, wait. You gotta keep going.
That's the joke. But I think in terms of like things that I think are like.
Oh, the joke. Okay, sorry. The joke about a horse or boat is that is a depreciating asset that.
Yeah, I mean, you have no operating. It does not give you operating leverage in your life, right? Having a boat or a horse.
Okay, I thought the joke was going to be that boat lets you move more stuff over water or horse. That's more operating leverage. Anyway.
No, it is. It's a joke that it does not. It is the opposite. But as an idea that like I really think more people should think about is operating leverage, which is like, what is my theory of how my business gets better over time?
Yeah.
Right? Like it can't only be a thing that you put $1 in and only 80 cents coming out, right? Like over time, it has to be, okay, $1 in, $1.20 comes out, $1.50 comes out. So like, where's the operating leverage in my business? And what's my theory of it? And when do I see it? When should I see it?
Right.
Right? Because in the beginning, people everyone's like, oh, like, I don't know what CAC is. I don't know what LTV is. Like, it's too early. I can't tell. Fine.
Yeah.
But like, you should want to know.
Right.
At some point, the math has to work. And so, like, I think that's why, yeah, I'm never going to own a horse or a boat. But if I ever did, if I won one at a fun fair, like when you win a goldfish, like that's what I would name it.
So I think the question now is what founders should do, right? Because they got to sell customers, they got to
validate.
Yeah. Okay. I'll add to that, right? Which is, I think that when there's a lot of capital availability, there's a lot of time and therefore money that can be spent for your experiments, right? But I think when you have a capital staff environment to some extent, then you have to validate on a much tighter, much faster cycle, right? And I think you talked about it in the previous episode about the rate of learning. And so I think what happens is that I think people got used to a certain, like, okay, we're going to spend $100,000 on this channel to figure out if it works, right? And you can't. Like, you should be like, I think if I spend $1,000, what does it tell me? Let me change it. Let me spend the next $1,000 and then kind of go from there, right? So the efficiency of that learning is really, really key.
Yeah. And sometimes, like, I can't tell whether people are slow because they don't know how to be faster or they think they're going fast. You know what I mean? Like,
Both.
It's like, is it you just don't know what fast looks like? Or you've picked like the absolute slowest way to try to test something?
Different folks, right? I mean, I think there are folks who just, like said, they come from a certain background, right? Maybe slower, right? Consulting or kind of like those big companies that tend to have a little bit more of a, I wouldn't say infinite budget, but
it's time and money.
Yeah.
But in a startup's lifetime is money.
Exactly.
Right? You're going to die.
Exactly. And so I think people just end up being way too optimistic about, and they're like, and I think especially for folks who do a successful first fundraise, they really expect the second fundraise to go well or just as easily as it did. And so they have this, like you said, maladjustment, right? And they're like, yeah, the money will come as long as you show these learnings. And I did all this work and all this stuff, bad stuff happened, but yeah, I fixed it. And that may still not be good enough, right? Yeah, I mean, to fundraise the next round, right? And so I think that's the awkward reality.
Yep. Yeah, and then, I mean, I think there's just so many tools now that make it pretty easy for people to validate quickly and cheaply. And I feel like I don't actually see them used enough, right? You can throw up a landing page, you can use Zapier, you can use Airtable, you can track with UTM codes. Like, it doesn't have to be a huge thing to test ideas.
Right.
And so I think having kind of orientation around that is important, just to be like, okay, I think it's working. I think the clue is just like, if you have to work really hard to sell everything, then you don't have product market fit. Right? You haven't yet defined the problem or the solution in a way yet that has people being like, give me this. Here's my credit card. I'm ready to buy.
Yeah. I think at the early stage, I think folks have really absorbed that because they grew up in this downturn, right, effectively. So I think they're more cash efficient. I think a struggle I'm seeing is really like the middle stage startups, right? Those that raised several rounds of capital, say, over the past 5 years, right? And now they have this new structure. And I think we'll talk about it, right, in terms of layoffs, the operating structure, but it's almost like I don't know what. It's just, I think what I've realized is that I've had to be very thoughtful in understanding where the current business is and helping them discuss what their challenges are. And more importantly, like talking about how high the next bar is, right? Because I think the previous rounds, the bar wasn't that high. And so I think as long as we make some amount of progress, the next round will come, right? But you can't get lulled into that. It's not complacency, right? But it's an expectation that as long as I hit these milestones, as long as I double my revenue across 2 years, for example, I could raise my next round. And is that a very fast rate of growth? Not tremendously in today's market versus the bar of what people want it to be, right?
Yeah. I mean, I think this is just, you need to have a backup plan.
Yeah.
Right. And so the backup plan is just like, okay, let's say I can't raise, or the raise that I thought is going to take 6 months is actually going to take 9 months or more.
Right.
Because I think that's the reality. Everything is just going to take longer, and you kind of don't want to be left with 3 months of runway and not have a term sheet on the table and then be scrambling, right? Because then you just put yourself in a way worse situation.
Let's talk about that, right? I actually know a bunch of companies that are fundraising with about 3 months of runway, right? For whatever sets of reasons. So what advice would you give to someone who's kind of like in that situation, right? But say below 6 months of runway. So
I would really just like try to do a zero-based budget.
Right.
And understand what is essential or not.
Right.
And I think the struggle is always like, well, if I don't spend money on marketing, then I don't show growth, and then no one will want to fund me.
Right.
But if I do spend the money on marketing, then I have less cash. And then, you know what I mean? Like
Catch
that's like
there you go.
It's kind of like damned if you do, damned if you don't.
Yeah.
But I think this kind of goes back to the like, what is your theory of the business?
Right.
Like, if you didn't spend any money on marketing, would growth really go to zero? Like, do you have no recurring element in your business? Like, what have you been doing basically for the last 2 years?
Yeah.
In terms of like, what about your business is ultimately real and sustainable?
Right.
That someone would actually want to buy and value.
Right. Right.
I think that's the question, right?
Yeah.
And it can't just be that you're good at spending marketing dollars.
Yeah.
So I think that's the sort of thing, is just sort of like you really need to come up with a plan B budget and plan that accounts for a really slow fundraising market, and be real about expenses.
Right.
Because you know how it goes, right? It's like everybody always wants to save someone on their team. If you sort of like went round robin and asked people who they cut, they're going to try to do the minimal amount of things. So you actually have to go like initiative by initiative and be like, does this actually move the ball forward for us in the time frame that we need it to? And how much does survival matter to you? Or, are you tired and you're kind of like, okay, let's just throw the towel in. It's other people's money anyway.
Yeah. I think the tricky part, and I've seen this for multiple founders now, is that they're fundraising with less than 6 months of runway. So they have a plan, right? They have a projection, right? They have a forecast. There's a certain rate of growth they're trying to execute against. And they've also heard the stories about how people squeak in that fundraise with like 1 month of payroll, right? Those near-death experiences, right? And so I think there's that tension, right? Between this is, they keep talking to investors keep working the process, right? Some are fast, which is professional, and some people are slow and drag things out, right? And then you end up in that kind of like, I don't know, stall zone, right? You're not really flying, kind of like dropping out of the sky a little bit, because you can't cut, because if you cut, it seems to risk the fundraising progress or traction that you have right now. But if you don't cut, you're going to hit a wall in 3 months' time, right? The brick wall.
You have to draw a line, right? There has to be a date where you have to make a decision.
Right.
And you have to be honest. You have to be honest about what the fundraising progress is. Having a first conversation is not progress.
Right.
Right. Are people doing work? Are they in the data room? Are they spending time?
Right.
Because if they're not, then I think it's not going to lead to a quick term sheet.
Yeah. I think people also underappreciate that, right? Which is that I think funds take time to write a term sheet, and funds take time to wire the money after due diligence, right? So if you have 3 months of runway and a fund takes 3 months to issue a term sheet and wire the money after due diligence, that's not enough.
You're cutting
time,
it really
right?
close.
Well, you're cutting really close, so there's not enough time, right? And I think VCs often say, like, don't catch a falling knife, right? There's too much.
I mean, I think there's practical stuff too, right? Which is like, try to defer your payments as much as possible.
Right.
Right. Take advantage of all the sort of payable terms that you can.
Right.
And try to collect faster.
Right.
I think when things are going really well, people sometimes are not that disciplined on collections.
Right.
And so there's some bookings number, but the cash collected number is like really far behind.
Yeah.
And so, you should kind of really sit on top of your cash cycle.
Yeah. Cash is an important one. Zero-based budget. I agree. But I think you said something earlier, right? Which is like, but if I cut marketing, I will cut growth, right? And obviously, if marketing doesn't drive growth, we'll cut it, right? But at some level, cutting that stuff is going to lower your growth rate, right? So the bullet that the founder is like struggling is,
okay. So I mean, so that's the question, right? Which is like, okay, so you spend and you hit the wall and you don't raise money,
right?
So that's scenario A.
Right.
You cut, growth slows, and you don't raise money. That's scenario B.
Right.
So which one leaves you in a better place?
Right. I mean, I agree with you entirely. I think it's quite asymmetric, right? Which is that I think from a founder perspective, one is at the end of it, you have no business, and at the end of it, you still have a business as a going concern, right? So to me, I agree with you that there's that, but it doesn't. But I think my frustration is that I think from an investor perspective, especially for a lot of current investors, is that I don't know. It feels like there's a lot of advice to like keep going, keep fundraising, right? You get it, right? I don't know. Yeah.
Like you said, right? It's really hard because. So, how do you decide which line of action you're going to take? And if we kind of played out the scenarios, right? Scenario one, you just keep spending on marketing, but you don't raise. You're unable to raise. Okay, that's scenario one. You hit the wall. Scenario two, you cut marketing, growth falls off a cliff, and you can't raise. And then, of course, the golden scenario, which everybody wants, right? Which is like, hey, you just keep spending on marketing and you can raise. Or you cut marketing and you can raise. And so I think for me, it also hinges on where the founder's head is at.
Right.
Right. Which is like, is it that if they cannot raise, they'll throw in the towel?
Yeah.
Then, hey, scenario A, guns blazing, spend to the end.
Right.
Or is it like, actually, there's some asset you've built here.
Right.
And you're willing to cut marketing spend because you need to preserve the asset. You want to be in a default alive state,
right.
even if you cannot raise.
Right.
And actually, that's my preferred scenario.
Right.
Which is like, we have a clear understanding of what our asset is.
Right.
So let's say our asset is today something that if we spend $0 on marketing, it'll grow organically at 10%. Right?
Yeah.
But what we've been doing is spending on marketing to try to push that number while telling a story of some sort of increased LTV over time because we're going to put more stuff into that. I would rather cut all of that future spend, right? That spend that's going to pay off in the future and be like, okay, this thing grows at 10%. I'm at positive contribution margin and I'm going to default alive. And either you believe in the asset I built or not, but I can go back to market in 6 months. Right. That's kind of my sort of old-fashioned view.
Right.
But I think the concerns are real, right? Because what's going to happen? Okay, so you cut people, right, in that scenario. Right. Then morale is going to be in the toilet. Maybe even some of the founders are like, oh, we've been at this for a while. Now we have to cut founder salary. It's not fast growing anymore. Is this still sexy? Whatever. Yeah. So those are real concerns. But I do think it kind of boils down to what's the founder in the game for? Right. And a lot of stuff just is kind of shitty right now.
Yeah. I agree with you. I think the cost of action to me is quite asymmetric, right? In terms of risk and reward, right? Which is one is you have a company and the other one is you don't have a company, right? And so I think the one that gives you a company lets you kind of live to fight another day, right? Especially in the environment and all these other reasons. I think what I'm frustrated about is I think a lot of founders are getting suckered by, I don't know what's the word, investors are very nice and kind of keep the conversation going. But also to some extent, actually, maybe I've noticed startups who have had boards that are not doing that conversation that users had, right? Which is, we got to be face up to this and manage it super tightly and get it under control, right? And so as a follow-on investor to somebody else, is it really my spot to say what is your board?
I don't think you need to involve the board, right? I think you just need to have a direct conversation.
Yeah.
But you don't even have to reference the board.
Yeah.
Right? I think whatever your relationship is, the founder is hey, look, I'm not at the board. I don't know what's going on there.
Right.
But here are my thoughts.
Right.
But at the end of the day, like I said, it all boils down to the founder.
Right.
And
the founder's the boss.
The founder's the boss, and if you've been operating here in the last 4 years, you've gone through the global pandemic,
right?
That crazy boom, and then now you're this the flip side of that,
right? And
I don't blame people if they're tired. It's very tiring.
Yeah, it's super tiring. I think I like what you said, right? Is at the end of the day, whatever the board is, whatever it is, I think the founder is the boss at the end of the day, right? And the founder has to make a decision, like you said, to see reality as it is. And to know to make the hard decision, right? About, like you say, option A, option B. There's a mathematics, right? The math has to work eventually, right? The gravity will kick in, and you got to make a decision. I think it's okay to keep the options open and to keep that there, but like you said, there is a date where the decision has to be made, and you got to make the decision.
Yeah, because if you don't make a decision, that is making a decision, right?
Boo.
Boo.
I don't want to make a decision. Like, if I don't make a decision, then no decision is made, right?
Yeah, you're running as hard as you can towards that wall, and you're trying to figure out if you're hoping that somebody's going to come and save you, but that's something you actually don't have control over.
Yeah, that's the tough part, right? At the end of the day. So, man. So how?
Well, we need to end off the episode on a more positive note, Jeremy. It cannot all be doom and gloom.
Okay, fine. Let's work on it. Okay. Well, it's like the doom and gloom episode. I would say that one thing that founders can do is okay, I'll say this. I would say that if you have to shut down your company, your life is not over. That's what I would say, right? You are not a company, and the company is not you, even though a lot of it is dependent on your decisions and your team. But a shutdown of a company does not mean that your life is over, right? So in fact, Silicon Valley is full of those stories, right? So on that note, I think if you are a founder and you are departing a team because of disagreement or because you want to search for something new, your company is winding down, or you manage to sell the company, we do have a community called the Phoenix community under Brave. It is a small group of about 2,000 founders who are currently transitioning to the next stage. And what we do is that every 6 months, we have kind of like a virtual offsite where we do journaling, we talk through stuff, and we also hear from a panel of other founders who have kind of like already successfully transitioned to the next chapter in their lives. The next one is in June, but we have another one in November, December. So check out www.bravesea.com to sign up for details. And it's a good group of folks, and we have a WhatsApp group, and we just kind of like help each other there, because at the end of the day, like look, if you build a company, you're crazy, you're brave, you're entrepreneurial, you care about the future, you're taking initiative, and now you've eaten shit and you're building something for the future again, right? I think there's only success in the future for you. The question is, how do we get there in a way that's thoughtful, humane, preserves your honor, and preserves your reputation for the community, but also does the right thing at the end of the day, right? And I think that landing can be hard to stick. So I think that's how I think about it.
That's awesome. I think founder communities are super important for the ecosystem. And so it's great that you're doing this. And these are the people who hike as well every Sunday, Jeremy?
Oh yeah, we have another group that's called like current active founders who kind of like hike every month, just get some nature and just chit chat, get some steps in. And those are two very different communities, you can imagine. And I think actually I've noticed that there's some folks who are in the hike community who are now slowly transitioned to the Phoenix community, right? I look at it as like complementary in that sense, because it's just different stages in life, right? I've been a founder, then I stopped being a founder, and then I had no idea what to do with my life as a student, and then I was a founder again, and now I'm a VC, right? So I think these identities are transitional, right? And temporal.
Very cool.
Yeah.
Well, I don't
Shi
be
Yan,
left
I think
out.
you also.
Yeah, I'm going to pitch you a in-person event.
Yeah.
So we are hosting Camp Hustle Asia in Bali the week after F1 in Singapore. So that's September 18th and 19th.
Yeah.
I'm pretty excited about it. It's an investor-focused event. We've got a group of pretty interesting speakers, but really the focus of the event is not so much like sitting and listening to people, but really interacting with everyone who attends. We just had it last week in the Bay Area for the US-based folks, and it was awesome. It was super chill. It was outdoors. People had great conversations. We had fund managers fly in from Latin America, Europe, all across the US. And so it was just a really kind of a no BS, really chill hangout. And we want to replicate that in Bali. We've got a handful of confirmed speakers I think people will enjoy. Moses from Zendit, Arthur Chua from Goldbell. Yeah. So he's like a second gen CEO who took over his family business, but has also launched his own technology startups as well as a mobility focused venture fund. Yeah. We have Ethereal's GP Min, which is a Singaporean GP. It's the fund with Joe Lubin, who's one of the co-founders of Ethereum. We've got Gabby, who's the founder of YGG, and a couple more kind of up our sleeves. And so I think it's gonna be a really good crew.
Yeah.
And so
you and I will be there as well.
We're gonna be there. We're gonna be grabbing people, recording snippets.
Yeah.
Jeremy's gonna be running around with his headset and his like microphone.
Yeah, pretty much. Yeah.
But yeah, I think entrepreneurship, investing, it can be a lonely journey. And so I think building community of people is a really important part of that. And it's part of the fun.
Yeah.
And so we are doing sort of early bird discount codes. So if you want, Sheehan's Friends is the discount code.
Spell it out. Yeah.
SHIYANS, Sheehan's Friends, FRIENDS. Oh my God, I can't spell. We'll put it in the show notes. Okay.
Yeah.
But it's only valid until June 1st. So I think this will be published like May 29th. So you have 2.5 days or something to use this. So
if you were listening to this on your Overcast queue and for the weekend, I'm sorry you missed it.
But I think it's going to be a good time. And then a lot of people, I think, are going to hang out afterwards. Yeah. So I know there's a bunch of Angel Squad members who are planning a dive trip in Bali after the conference. And so I think it's just going to be really chill and relaxed after the madness of, Milken F1 Token 2049 the week before.
On that note, let's call it a show.
Boom.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.